the Financial Survival Network. Now more than ever.
And welcome. You are listening to and watching the Financial Survival Network. I'm Kerry Lutz, and today is a 1/6/22, a day, I guess, that the media would love to forever be in infamy. But in the meantime, the new year is upon us, and figured it's a good time to take a couple moments, review what's happened and what we think is going to happen in 2022. Our good friend Andy Schectman of Miles Franklin is with us now. And Andy, always great to have you back. Happy New Year. So gold demand, what's happened since the first of the year?
Well, happy, healthy New Year to you, Kerry, and all of yours. And it's always good to see you. Good to be back. Sure the hell was a crazy 2021.
Oh my God.
What's happened with gold demand? It's more of the same. And I guess we would say silver demand more than gold. Looking back on 2020 and 2021, both years were record years. Both years, the number of, or the percentage of our orders that contained silver, either entirely or a portion of, was over 95%. The last 2 years has really been the year of silver. Gold is really lately has been, it seems to me, reserved for the central banks and the commercial banks and the sovereign wealth funds and the money managers, less the public, albeit they're, I don't want to make it seem like no one's buying gold. That's not the case, but really the demand has been with silver, and it's continued. And I think that really there are a lot of people who are mostly concerned these days with leaving money in the bank. And that's the overwhelming comment that we get over and over and over and over again. People just don't want to leave their money in the bank. And robust isn't even the word in terms of physical demand, which is counterintuitive when you look at the pricing. Price has not maintained its correlation with demand. And that has a lot to do with the fraudulent and leveraged price setting mechanism on COMEX. But I can tell you that from a physical standpoint, from a demand standpoint, it's still, the last 24 months have really been incredible in terms of demand. And I show no sign of it abating whatsoever.
Hey, so when you're looking at the COMEX and, they're still attacking gold, the price pattern seems to have changed because they knock it down $20-$30. It pops up a day or two later, 3 days later. That's something that looks a little different, doesn't it?
Well, there's big demand, and that demand is not just physically here in the retail industry. You got one trader who's long 40,000 contracts on COMEX, a managed money trader, and that's 4 million ounces of gold. That's $7 billion worth. You have very large money interest starting at the top on down with the central banks and the commercial banks that have been voraciously accumulating gold now for the past 2 years. And so, that type of demand at the highest level has put a floor under the price of gold, albeit the volatility and the counterintuitive nature that we see in its price action, these smashes when there shouldn't be, is what has kept the masses out of precious metals. And I understand why people would not really want to look too closely at precious metals when you look at inflation running out of control and craziness all around us. And yet, gold and silver had a very lackluster year in 2021. And so, I've said for a long time, Kerry, price is a tool of misdirection. If you lift up the hood and look under it, you see price being used as a tool to accumulate gold and to keep people from kind of following the scent, if you will. So big money, in particular, the commercial and the central banks and the managed money traders, in particular, this group on COMEX that we've called the others, mostly sovereign wealth funds and family offices, have been using the manipulated COMEX price to accumulate copious amounts under the cover of this manipulation. And so, yeah, I think that that in and of itself is pushing the price right back up. You can look to today as an example where the price, really fell quite a bit into the 1700s, and here we are back up above 1800 in just a matter of hours. It's that volatility, it's the counterintuitive behavior, and it's of course the equity in the crypto markets that seem to have had until just yesterday really no limit as to how high they can go. That is misdirecting the public away from precious metals and into other asset classes.
Yeah. And like our good friend Craig Hemke says, they knock it down, but once they hit the physical floor, all sorts of crazy things happen, and then it bounces back. And, I've heard some indications that, we're having a bounce now, but it could get severely knocked down one or two more times. And then it's going to be off to the races.
I believe that because, if you look at what just happened, I think there were a lot of people who believed, the Fed announced that they were going to reduce they were going to begin to taper. And I think the market believed that this would be the case in a short term type of situation where we would see them make a half-hearted attempt to raise rates, to slow their bond purchases from 120 billion a month down to 80 billion or whatever it would be, which isn't really, stopping purchasing mortgage-backed securities and government treasuries, just purchasing less of them. And I think the market believed that this would be a short-term deal, that we would see gyrations like we did in 2019 that would give them incentive to stop tapering, to stop tightening, and to go back to an accommodative policy. And that's really, both if you look at the long end of the bond, the market really didn't believe the Fed. And if you look at the just the rhetoric that was pervasive in this industry, people did not believe that the Fed would follow through. Well, it seems like they've kind of dropped a bombshell here recently. And I think this is why the market is behaving the way that it is today and yesterday. What came out recently was the Fed minutes, the December minutes. And they basically said that they're going to put the wheels in motion for its balance sheet reduction. Now, this is not to be confused with what they've already said, tapering. And again, up until now, I really do believe that the market didn't believe the Fed would follow through, but it seems like maybe the market was caught off guard. And I'm not just talking precious metals, I'm talking the crypto market, I'm talking the S&P, I'm talking the large markets are reacting to the December minutes that just came out. They talked about at least 3 rate hikes this year, at least 3 rate hikes next year, and 2 to follow, a total of 8 rate hikes over the next 2 years. And where they caught the market off guard is in the minutes, they talked about cutting back the amount of bonds that they are holding sometime after they start rate hikes. So the market is kind of pricing in, it seems, the first rate hike to be in March or April at the latest. And last time we saw that, we saw in 19 a taper tantrum, and that's what they called it, where the market really went into gyrations. But the market has become addicted to stimulus and money printing. And you can see that when you realize that, according to the Bank of America's flow show chart, 19 years worth of money went into the US equity markets in 1 year. They said $900 billion went into the US equity market last year, which is $100 billion more than the previous 19 years combined. This was from easy money and stimulus, where hedge funds, as an example, can borrow money at next to nothing, plow it into the equity markets, plow it into investments, watch those investments skyrocket, creating distortions in price discovery, cover their loans at next to nothing, make a fortune not only in their investments, but also in their bonuses. This addiction to stimulus and easy money seems to be coming to an end. In fact, what it appears is that not only will they cut back or taper, but some people believe that they will actually cut back completely their asset purchases in March or April. And I think that's what really caught the market off guard. I think the markets did not expect that they would do this all at the same time. They thought they would taper, then lift rates, and then sell the bonds. But it appears as though that they're planning to do all of this at the same time. They also went on to say that they plan on selling their bonds at a faster pace than they did previously, like in 2017, which plunged the S&P by 17%, which led right up to the repo market crisis in 19. And bang, here we are back doing the exact same thing with accommodative policy, with lowering rates, with stimulus and whatnot. And so the bottom line is that over the next 2 years, they're expecting 8 rate hikes of at least 2%. Now, up to at least 2% or higher. And, corollary to that is the real estate market that I think people are not really paying attention to. Real estate experts will tell you that a 1% rate increase can lead to a 10% decrease in the value of homes. And with all the people over the last 2 years that have plowed in here in Florida as a prime example, where I play golf with a guy who bought a house in 2020 and sold it in 2021 for $1 million profit, paid $1 million for it, sold it for $2 million in 1 year. There are a lot of people who have plowed into real estate over the last 2 years at all-time highs, factored against all-time lows in interest rates. And if we see rates rise up to 2%, you could theoretically over the next 2 years see housing prices drop by 20% or more. And for all the people that plowed in, myself included, at high levels, could be facing negative equity in a short period of time. And this is what I think is really freaking out the market. Now, when you factor all of these things together and talk about overvaluation, even look at the Buffett indicator right now, which is showing the US stock market is at 218% of GDP. These are way overvalued numbers. So you're talking massive overvaluation in equities, massive overvaluation in real estate, massive overvaluation in the bond market. You have 3 of the pillars of wealth in this country, all at all-time highs, that have become addicted to stimulus and easy money. And if the Fed and their December minutes are true, and they follow through with this, really going to become hawkish on inflation, well, that's what's, I think, triggering this panic right now in the markets. And I guess we'll see if they really plan on following through with it. But there are a certain part of the market right now that believes them and is selling off right now, realizing that profit isn't a 4-letter word and taking the Fed at their word that they are going to actually follow through with not only tapering, but also selling off at a faster pace than before, their assets that they've levied up to $8 trillion on their balance sheet, from 4 to 8, and letting rates rise. And, in 2017, 18, 19, when they started doing this, it's important to note that their balance sheet was half of what it is right now, and it was somewhere in the neighborhood of $3.5 trillion. They sold off down to about $2.75 trillion, not even $1 trillion, and the market threw up. What's going to happen if they really start to dump mortgage-backed securities, really start to dump treasuries at the same time that they're not plowing money into these markets, creating these lofty valuations? It's a rubber hits the road moment. And I think that's what's creating the sell-off, not only in crypto, in equities. We see 2.5% down yesterday in the S&P 500, and today slightly in precious metals. So very interesting times, Kerry. And the old Chinese curse, may you live in interesting times.
Well, we're certainly doing that now, Andy. And I'm not so sure they're going to follow through, but the path that they're on, at some point they got to make a choice between the dollar and the economy and the stock market. I like to say, originally, for the past 40, 50 years, the Fed had 2 primary tasks they were charged with that were conflicting in their own right. Number 1 was keeping price levels stable, whatever that means. And number 2 was keeping employment at or near full employment or optimal levels, for lack of a better term. And now their third responsibility is to never let the stock market go down. How do you balance those 3 responsibilities?
You don't.
I know.
You don't. And this is why also you see underreporting in inflation, where John Williams says we're closer to 15% than we are to the CPI's number of almost 7%. And, you look at the unemployment numbers, they're better than they were before we started COVID. The only problem is look at the labor participation numbers.
Mm-hmm.
You have people quitting their job, just not working because of all the government stimulus. And you have poor labor participation numbers, but the unemployment numbers are no worse than they were before COVID started. And so they really can't use the unemployment mandate anymore. In terms of price stability, that's where, this is what they're talking about. Inflation is getting real, and it's been real, and it's been real since they called it transitory. So I guess we'll see what they've chosen. I have felt, and I've said publicly all along, that I believe that they would choose the equity markets and the real estate market and the bond market over the health of the dollar. Maybe I was wrong. Maybe they're trying, maybe this is a bluff. I think the market didn't believe that they would really do much of anything. I think when they talked about tapering, the market believed it was kind of a lip service, if you will, that they would just do it for a little bit and then find reason to reverse course and go back to their accommodative stance. But if you look at the December minutes, every single one of the Fed governors said that they need to not only pare down and sell off their balance sheet, but do it at a faster pace than they did before. And I think this is really frightening the market. So whether or not they follow through, and in the back of my mind, in the back of most people's minds, I think they believe that this is a threat, maybe more than reality, because of what it will do to the markets. But, I guess we'll have to see. And, the crazy thing about it is that everything they're talking about is raising rates to just 2%, which is still historically ridiculously low. But this is part and parcel with how high the asset prices have become because of the Fed policy, where if you really get to a normal interest rate environment, everything collapses. So is it part of the plan? Do they want things to collapse? Are they going to go higher than 2%? Are they really going to sell off their assets? If they start selling off a ton of mortgage-backed securities and treasuries, and they really start to taper, you will see interest rates rise, and asset prices, simple economics, have to fall to price that in. And so you will see a collapse in real estate, in stocks, and the mother of all bubbles, the bond market, will take it on the chin. Some would say it's overdue, that Mother Nature always gets her way in the end. You can manipulate, but mathematics, economics, and Mother Nature will catch you, just like Father Time will. And that's kind of the, I think the problem here is that, maybe the Federal Reserve thought that they were smarter than Mother Nature. They could outwit mathematics. In the end, you can't. And I think that's really what we're heading here right now. Are they going to let things normalize to find real price discovery? That's what the December minutes are saying. I don't know if the market really believes it yet, but you see them start to follow through and stop all at the same time, raising rates, selling off their balance sheet. And I think you'll see some real gyrations that people will really not like. And this is just the very opening salvo, if you will, because these minutes were just released yesterday. And I think that is exactly why the market sold off yesterday. And we'll see how serious they are, and just indeed how the markets react. But if indeed they are serious, this is just the very beginning.
Yeah. Well, I guess we're going to find out whether you should call the Fed's bluff or not. At the same time, we've got record deficits taking place, right? And well, enough to where it would normally sink a currency when you talk about record deficits. That's right, and trade deficits. It would sink a currency. So yeah, and that's kind of the problem. Is the
they've got to get their house in order, or we're in big trouble as a country and as a currency. And I think the dollar really is people have believed that the dollar would be sacrificed, and maybe just maybe they're going to reverse course and let the markets correct and try to do a little bit to stave off the demise of the dollar.
So getting back, the future is quite uncertain as always. Do you bet against them, or do you bet with them? Usually in the past, going with the Fed is the way to go. But if they're doing the ultimate Hail Mary, all in on a pair of deuces in the poker game, so to speak, then maybe you have to go against them this time.
Well, Chris Moneymaker won the World Series of Poker all in on a pair of deuces. So, I think that betting against the Fed is typically a losing bet. The question is, how serious are they about following through? And if the markets start to gyrate, which I would expect them to do so in a very large way, do they continue to hold tough on their hawkish stance? I guess we'll have to see. But this is what I believe is scaring the markets right now, that there's a certain segment of the market that believes they're for real. And rather than go all in with, a deuce eight, they're going to take their profits and run. And quite frankly, I think it's not a bad idea. Again, profit is not a four-letter word. And if you're sitting on, profits in cryptos, if you're sitting on profits in equities or in real estate, getting out of harm's way and sitting on the sidelines and seeing how this all plays out really isn't a bad idea. The problem is sitting on the sidelines in cash is a sucker's game right now when you have, by the CPI measurement, inflation running at 7%, when we know it's probably double that according to John Williams.
Yes.
But at 7%, nonetheless, your purchasing power is being destroyed by rampant inflation. So, are they going to try and fix that? I guess we'll have to wait and see, Kerry. But there's a great amount of uncertainty. There's a great amount of fear, and it's not just in the markets. It extends much further than that. Everyone understands what I'm getting at there, all the way down to moral, political, social, religious, you name it. There's uncertainty, there's fear, this is just a world that I really don't recognize over the last 2 years. So we do the best we can, we roll with it. When I tell people to buy precious metals, it is not to get rich, it is to protect your purchasing power. It's got 5,000 years worth of history behind it. It is wealth, it is not an investment. I think everyone needs to own gold and silver right now. Simply because the dollar is at the end stages of what has been, quite a run. And are they able to pull it out and maintain its singular world reserve status? Maybe, hopefully. But this is why we own precious metals. We are offering on special right now things like silver buffalo rounds at $2.99 over, Valcambi kilo bars at $2.75 over. We have lots of product as much as possible, but I'll also simply say getting product has never been harder ever in the 30 years that I've done this, ever. We have to buy stuff 60 to 90 days out. And, you look at the Austrian mint, which has been great throughout COVID. They've been ravaged recently by the new Omicron strain and they're shut down. You look at the UK mint, they ran out of silver blanks 2 months ago and hardly produced anything. You look at the US and the Canadian mint, they're the model of inefficiency. Getting product has been ridiculously hard. It is nothing like it used to be. And this is with a very small percentage of the populace invested in the metals market. When there is an awakening, and I think if they follow through with this tapering, with this selling off of their balance sheet and raising rates, if they follow through with it, and the market really does start to experience trouble, you will see, I think, a massive awakening, greater than the expansion we've already seen into the metals market. And I swear to everyone out there listening, as God is my witness, getting product will be impossible because it's hard right now when less than 1% of the population owns any metals. What happens when 5% wants in or 10? Overnight, it'll disappear. And that is as sincere and honest as I can be. That is not talking my book or to attempt to fearmonger people into buying gold and silver. I just simply will tell you, I truly believe it will define the market. The physical precious metals market will be defined by an inability to easily source product.
All right, Andy. So here's the question. It's not for me, not for you, but many of you out there maybe don't have a lot of precious metals, maybe haven't thought about buying, maybe have none, and you're going to get started. Do you buy silver or do you buy gold? Now, on the one hand, I think silver's future probably is greater than gold, but on the other hand, its potential appreciation. On the other hand, you get into storage constraints if you're buying a lot of it that you don't have with gold. So what's your take on this?
Well, I think that silver is the value proposition of a generation. It is depleting in nature. It is massively expanding its use cases in green and digital applications. You look at all of the automobile manufacturers. GMC just announced they're going fully battery powered by 2030. It's that way across the board. A good friend of mine here that I golf with just sold a Chevy dealership and told me that all manufacturers are going electric within the next 15 years or less.
Oh, yeah.
This all needs a copious amounts of silver. And so when we talk about silver in its relationship to gold at roughly 80 to 1 being ultimately 11 times undervalued, when you look at its relationship to gold versus what it's coming out of the ground at, it's coming out of the ground at 7 to 1 globally, 7 ounces of silver for every 1 ounce of gold, yet it's priced at 80 to 1. This is the value of a generation. And you're right, $100,000, $1 million worth of gold you could put in a briefcase and sprint to your car. $1 million worth of silver, you would need about 14 wheelbarrow loads back and forth from your safe to your car. Would be tough.
You need a crane for it.
If you talk 100 grand, easy for people to understand. If you were talking $100,000 worth, well, let me show you something here. Hold on. Right here. It's 80 ounces of gold right there. That's $160,000 worth of gold. Run out my door.
I'll be over your house in an hour and I'll buy that from you, okay?
I'm heading to Brinks right now, so you meet me.
Oh, man. I'll meet you at Brinks.
That's 80 ounces of gold. That's $150,000 worth. You would basically be looking at 10 mint boxes of silver coins for that 450 pounds versus this, the same amount. And so when we talk about storage versus 10 boxes that weigh 42 pounds each that are this big. So, but I will tell you that I think silver is the value of a generation, but the central banks who reclassify gold as a riskless tier 1 reserve asset will tell you that ultimately, the place to be is in gold. And I think silver is a pathway into getting more gold. You buy silver at an 80 to 1 ratio, you realize that it's averaged 42 to 1 for 150 years and it's coming out of the ground at 7 to 1. You buy silver now, you trade it to gold. When the ratio normalizes, it is the trade opportunity, I think, of a generation. Also, anyone who wants to get into gold will have a greater ability to increase the amount that they can buy by buying silver right now. So I guess to answer the question, I think you should own both. But I think that if you're willing to take a calculated risk, you buy silver right now, you switch it into gold when the ratio normalizes. And I think it's as good of an opportunity as I've seen in 3 decades.
I'm inclined to agree with you there. And then the question is, what do you buy? Do you buy rounds? Do you buy kilo bars, 10-ounce bars, 100-ounce, or do you buy junk?
Junk silver used to be the best way to do it, but it's too expensive right now. Kilo bars, we have 700 or 800 Valcambi kilo bars right now on sale. They come with certificates of authenticity. They're fantastic. They come in boxes of 15 per box. If you're looking for the biggest bang for the buck without being penny wise and pound foolish, I'd buy the kilo bars. They're 32.15 ounces. They're 2 pounds, they're about the size of an iPhone. And they're less money than the 100-ounce bars right now. I also like the 1-ounce silver rounds and the 1-ounce sovereign coins. It depends what your motivation is. I think for what you want to keep, I would do it in coins. For what you're considering in bulk or in trading into gold, I would do it in the kilo bars. No right or wrong answer. But look, and I mean this, ultimately you want to be in gold. You do. It's a tier 1 reserve, and there's only, US dollars and treasuries that are the only other tier 1 assets. So the biggest money in the world is telling you what they think of gold. But there's a 90% correlation over the last 5,000 years in the movement between gold and silver. I would choose silver right now if I were making a calculated risk with the intention of ultimately switching it to gold. Let me give you an example of how that played out real quick. In 2010, when I started doing podcasts, I was begging everyone to switch their gold to silver because we were at an 85-to-1 ratio. It was the second time we've been there, maybe the second or third in human history, meaning 85 ounces of silver was equal to 1 ounce of gold. Within 8 months in 2011, you had $50 silver and $1,915 gold. That's 37-to-1. So anyone who would have traded their gold to silver at an 85-to-1 ratio, meaning they got 85 ounces of silver for 1 ounce of gold, 8 months later could have traded 37 ounces of silver back to 1 ounce of gold, nearly tripling what they started with. That's what I'm getting at. You play the ratio. You buy it at 80-to-1, knowing we've only been here 4 or 5 times in human history. And when it gets to below its 150-year average of 42-to-1 and overshoots it like it did in 2011, or maybe gets closer to its geologic ratio right now, single digits, the return into gold is fantastic. 2, 3, 4, as much as 10 times the return. So, I think it's a distinct possibility. And the one thing that I've learned over all of these years is that bull markets go higher than anyone thinks possible, and bear markets fall further than anyone thinks possible. And the same thing goes for price projections. I think that we are well undervalued in silver, and when it corrects, it'll probably overshoot. And to see a 20-to-1 ratio between silver and gold is not outlandish at all, considering that's still 3 times more than what it's coming out of the ground at. It's a real opportunity, Kerry.
All right. Well, we appreciate your input there and your thoughtful views on it. You got to look to the person that has the most experience in this sector, and that is definitely you, as far as people I know. There's a couple of old timers out there. They're kind of like phasing out, retiring. You're kind of the veteran out there. So I urge you all, if you're looking, buying gold, silver, other precious metals, you just go to milesfranklin.com. Andy, just tell them your phone number, your email address, and how to connect with you.
Absolutely. So a couple of things. You'd want to email us at info@milesfranklin.com. And in that, you would want to put that Financial Survival Network in the subject line. It is my promise to you, Kerry, and to your listeners that you will get not only personal attention, but the best price in the country. We are building a new website. We had to redeploy and restart the back end of our site. It should be done the first quarter here in 2022. However, for the time being, send us an email. We will send you a current price sheet that's updated all the time. One of my brokers or myself will reach out to you, give you personal service, answer your questions, make sure you get the best price in the country, the best service from a company that's never had a customer complaint in 31 years. We are licensed and bonded, probably the only major company in America that is. We'll make it a good experience. As far as phone number, they can call us at 1-800-822-8080. Again, mention you came from the Financial Survival Network. You will be treated like family, and the price will be accordingly. So appreciate the opportunity to work with you and your listeners, Kerry. I take it very seriously. I really, truly do, as do all my employees, all my brokers. And we will prove that to your listeners. In the meantime, I wish you and everyone out there a very happy and healthy new year. Stay positive, and I'm always here if you need me, Kerry. At the drop of a hat, I'd love to come back anytime.
All right, you got it, Andy. Hey, questions, comments, shoot me an email, kl@kerrylutz.com. Andy, we'll talk to you again real soon.
Stay well, my friend.
The Financial Survival Network. Now more than ever.